Happy Friday, everyone. My name is Kirsten Loita. I'm Senior Vice President of University Relations here at Osage University Partners. It's almost officially summer, which means it's once again time for OUP's annual Financing Trends webinar, which is a conversation on the current state of venture capital funding for startups. We welcome our partner institutions to this webinar. We view these webinars as a great opportunity for our partner institutions' technology transfer offices to ask questions in real time to our investment people that they may have on startup financing trends for particular industry sectors. You'll notice a poll appearing on your screen at this time. If you could fill this out, we'd love to know how many people are attending this webinar. This gives us a really good idea of the popularity of the webinars and how we're doing. So now we'll go around the room so my OUP colleagues can introduce themselves. Anurag, do you want to start out?
Yes, thank you, Kirsten. This is Anurag Agarwal. I'm a senior associate on the life science investment team. My background, I'm a cell biologist by training, and then spent a couple of years in healthcare strategy consulting at Boston Consulting Group before joining OUP.
Great. David?
Hi, I'm David Dorsey. I am a senior associate on the tech investment team. Most of the deals I'm looking at are software, cybersecurity, advanced computing, machine learning, etc.
Hi, this is Stephanie Stamen. I'm a principal on the life science investment team. I'm also a cell biologist by training and worked in consulting for a few years before joining the life science investment team here at OUP.
Great, thanks everyone. So our goal today is to provide guidance to understand current market behaviors among startups and cover current areas of investment interest. This year, we will again discuss general venture activity and investment trends specific to OUP's University Startup Network. There is no dedicated Q&A period during this webinar, so we encourage you to ask questions throughout the webinar. If you would like to submit a question, please use the Q&A feature on your toolbar. We like questions, so just send them our way as you were going through the presentation. So David Dorsey is going to start us off with overall tech venture investment activity. Then he'll focus on each of the following areas. First, financing and valuations, financing by sector, active and inactive sectors, financings by partner institution startups, funds investing in partner institution startups, and syndication. Stephanie and Anurag will then walk through life science investment trends with a deep dive on therapeutics, neurology, top investment regions in the US, IPO market, active and inactive sectors, active VCs and company formation, medical devices, and diagnostics and tools. So with that, David, go ahead and take it away.
Great. Thanks, Kirsten. So here we have a couple slides talking about overall investment trends. This is not just university spinouts. This is a snapshot of late 2018, early 2019 across all venture sectors. And the biggest takeaway here is that 2018 was a monster year for venture capital investment. There was $108 billion in non-life science deals, and that's a 64% increase from 2017. So it's just enormous amount of capital deployed. And following similar trends in years before, there's still a gradual decrease in the overall number of deals. So we'll get into some of the reasons why that's occurring in the upcoming slides. You know, for tech transfer officers, one of the things you're most interested in is the number of first financings, the angels and seed deals. These are the ones that, you know, really you notice because you have your early stage startups that are looking for their first investment. And unfortunately, those deals are continuing to decline as well. However, the ones that do get funded tend to have larger amounts of capital deployed in each one. So the bottom chart here is showing the number of deals by stage. And what you see is that for early VC, this is like Series A, Series B, and later VC, Series C and beyond, there is this gradual increase in the number of deals by stage. And then if you look at the green line, which is the angel and seed, you'll see that it reached kind of a peak at about 2015 and has gradually been decreasing year over year. But each one of these deals has more and more capital. So this, like I said, again, this is excluding life science. This is just tech, and it's all stages, non-university deals and university deals. Go to the next slide. So just following up on this again, is the, again, the number of first financings are downward, but as I said, these deals are becoming much larger. There's a dynamic that is happening. We've seen this happen over a few years now. What's happening is fewer deals are being done at the early stage, and the ones that are raising capital are raising much more capital, and there's a lot more competition to get in those deals. There are more and more VC funds now. There's more and more VC capital out there, and so these few deals are becoming more and more competitive. A lot of VCs are trying to get into these deals. So what happens is the startups are pushed to take on more money than they would probably have planned to in the first place. And so they're able to negotiate a higher valuation in order for them to escape a high dilution. And so you see this happening in the lower squares here. On the left lower is a chart that shows from 2007 to 2018. The Series A median pre-money valuation has gone from 7.2 million to 20 million. And for seed, it's gone from 1.9 million to 7 million. So these are pretty high valuations, and it's all part of this kind of dynamic where there's fewer deals being done with much higher amounts. Now, last year, I think we talked about this dynamic as well. The angel and seed deal, like you'll hear sometimes people say, like the Series A, the angel and seed is the new Series A. And so what's a pre-seed? And some of this is, I think, due to the fact that more and more startups are going through incubator programs. There's a lot more incubators and accelerators, especially in the US and Canada. And a lot of the startups are coming out with a go-to-market strategy. They've got their team built out. They have a product that at least has a proof of concept and maybe even some early engagements with customers. So that's one of the reasons why you'll see higher valuations, just because the average seed or angel deal is a little further along than it used to be. But the other part of it, I think, and it's a significant part of this dynamic, is the fact that there's just more capital available than there used to be. You have the next slide. And so I'm going to start at the bottom of this one just to follow along with what I was just talking about. So if you see here, this is the median deal size by stage. So what I was just saying here a moment ago about the trend is, if you look at there's the dark line, which is the angel and seed, and the later VCs, the median deal size for the later stages are getting bigger and bigger. I mean, you see this sometimes with like some of the later stage deals, especially in San Francisco, are just enormous rounds. So the rounds are getting bigger and bigger at the later stages, more so than you see in this early angel seed and Series A. But just the median deal size is just getting bigger and bigger. If you look here, the follow-on rounds in 2018 totaled nearly 12 times the amount of capital that was invested in first financings. And so that's what you have to realize. Like when you hear that there's lots and lots of activity in the VC community, you have to understand that a very small part of that is actually going to early stage deals that we're looking at. And the lion's share of the capital is really being put into later stages there. As usual, what you'll see in tech sector is that software is dominant. Software accounted for almost 36% of the overall VC spend in 2018. That's $47 billion. If you look at that top chart up there, there's this big section called Other, and the biggest block here is the dark green block for software. That's where most of the money is going. And the other reason I want to show this is because if you've got in your portfolio things that are like IT hardware, components that are being sold in the data centers, like optic chips and interconnects, if you've got energy deals, battery deals, membranes for fluid batteries, those are making up a very small part of the capital invested by sector. If you look, energy is that little tiny blue sliver at the top, and that little yellow sliver there in 2018 is for all of IT hardware. So again, it's challenging when you have deals that are directed towards, say, energy, materials, things like that. It is difficult because there just aren't as many deals being done, and the vast majority, it's always easier to get a software deal funded than it is some of the hardware deals. It still remains challenging here.
So we have a couple of questions from the audience, David. So one is on the previous slide, you talked about the deal value. Does that track the post-money valuation, or is it another gauge?
It's the pre-money valuation.
The pre-money valuation.
Yeah.
Okay.
So it's better to look at the pre-money valuation because later stage deals will end up looking like they have higher valuation just because they're raising so much more capital. So in general, we talk about valuations, we're talking about pre-money.
And the other question we have, maybe you can break this down for us, I'm not quite sure I fully understand this. Does the number of the deals track the capital invested in the breakdown?
The number of deals, those are separated out. So in one of the slides, we're talking about the number of capital the amount of capital invested. Like for example, on this slide here, we have the median deal size. Number of deals does not include the chart with the number of deals does not include the capital that's been invested. It's just the number of deals. So some of those will be $1 million deals, and some of them will be $20 million deals. By the way, like one of the other things you have to understand is just to think about like when I'm saying that like later stage deals and how much capital is being deployed in a few winners. I forget exactly what the exact number was, but if you look at that $108 billion total that was invested in non-life science VCs, $12 billion of that went to Juul, the nicotine vaping hardware. So that's what I'm saying. Like, I mean, they really are picking a few winners and piling just a ton of cash into it. The other category is another question. It's such a catch-all. This is from PitchBook data. It's hard to say exactly what is in other. It really is. Let me say this. Very few of the deals that we see coming out of university spin-outs are falling into this other category. They really tend to be kind of consulting and services, and some of it is some oddball hardware that doesn't fit anywhere. They really, very few of them will be in our portfolio.
And so would fintech fall in the other category or under software?
And that's the thing. Like again, the way they break this down, some fintech will fall under software if it's clearly software, but if it's like fintech services, but not a software product, it might fall into others. So it's not a perfect breakdown of verticals the way that they break this down. But the takeaway I was just trying to convey here is that software just is a really big piece of it.
Okay, great. Another question we have is that does the angel and seed part that we talked about exclude VC capital?
No, it definitely includes it. VCs are very active in the seed stage. Angels obviously are not, traditionally called VCs. But no, when we say seed deal, it's like an angel size or small investment from institutional and strategic venture capital.
Okay, but it's not broken down then?
No, they just lump them together. They lump them together. They call them seed stage.
Okay.
Yeah. So this is one of the other things I thought was interesting. So what, we get often asked, like, what are the hot markets and sectors and what's coming out of our universities are going to get funded. So what I did was I took 25 or 30 of the top tier VCs in the United States. And what I did was I looked at what they invested in over the past 15 months. And so the x-axis of this chart is saying the number of financing from top tier VCs. And these dots are labels associated with what vertical or some keywords that are associated with these startups. And in some cases, a startup may have 2 or 3 keywords like fintech and big data and blockchain, for example, might be one company. And then what I wanted to do is show on the y-axis here is the percentage of those financings that actually came out of a university startup. And just show, that, so that we can talk about the overlap. So like, let's start at the bottom here. If you look at the ones that are really small, like insurtech, e-commerce, real estate, and even fintech, these are ones where there is very little, 0% participation in some cases from university spin-outs. There's not a lot of real estate or e-com or insurance tech coming out of university startups. That's clear, right? So there's the VCs are doing deals in this space, but they're not coming out of the universities. And if you look at the ones where there are a large percentage of the deals, overall deals coming out of universities, you'll get like advanced manufacturing, VR, AR, robotics, autonomous, sometimes is robotics, and sometimes it is some kind of industrial processes, like but not necessarily robotics. It just has to do with sort of a closed loop feedback control system. And the reason I want to say that is because those are kinds of areas like IoT where there's a lot of stuff coming out of universities, but sort of they're not a big part of what's coming out of that VCs are actually funding. And somebody made an interesting comment the last time I was giving this talk, and what they were saying was, if you look at that y-axis, like the things that are up there but not funded by the VCs, a lot of these are the ones where the government has been most active in investing. So you'll see like advanced manufacturing, 3D printing, all those kinds of things are ones where there's lots and lots of SBIR and government DoD money plowing into it, but these not necessarily getting funded by institutional VCs thereafter. And then obviously, then there are ones like big data, AI, ML, where universities are participating in a space that's heavily invested in VCs. And if you look at that, like the AI ML slide there, I mean, it's actually remarkable. You're talking about about 100 deals that are being done, right, from these top tier VCs, and about 25% of those have university connections. I mean, that's a remarkable number. And it also tells you why you have it's so much easier for your software startups to get funded, right? If they say big data or AI ML, there's a complete overlap with what VCs are looking at and what the universities are producing. It's going to be a harder sell when it's coming out of something like advanced manufacturing. This just goes back to what we were talking about before. VR, AR, like we see lots of stuff, great stuff coming out of universities in VR, AR. It's just that I think that the VCs are still slow to move on it, and in large part that is, in my experience, because there's a lack of business use cases that we're still talking. I think in the future, maybe after 5G, you'll start to see more use cases and business use cases, but right now they're still aren't enough to get them excited. All right, so this one here is actually just data from our partner universities. So this is the companies that we track in our database. And this is life science. No, this is just in tech, university startups. And so actually the trends for deal count and capital invested, what I want to show here is they look exactly like the overall trends. In the deal count, you see that there was an increase and now it's starting to decrease. But the amount of money per deal is increasing year over year. So it actually is a very similar trend. So university, like startups, are actually experiencing the same kind of market that everybody else is. And then on the left side table here, we have in 2018 the top tech startup investors. Osage University Partners did 9, Data Collective, Khosla, Intel Capital, Y Combinator obviously does a lot of deals overall. They kind of invest a lot in every space. Baidu is doing more. Sequoia does a lot of early stage deals. Alumni Ventures Group, M12 out of Microsoft, and so forth. These are the most active. Some of these are accelerators, like Berkeley Skydeck Fund. And so, you want to take a look at these. Like these are the ones you should be looking at if you're looking for early stage funding. And this is the last one here. This is something you want to think about from our perspective as VCs. The rest of the syndicate matters too. And so, it's helpful sometimes to kind of think about how other VCs think about other VCs when they're building syndicates. So we are hoping that startups can attract attention from VCs that we think possess these certain characteristics. Like, for example, they're rational thinkers. What we don't want is to talk to a VC, ask them why they're interested in a startup, and they tell us that it's just a really hot market right now and they want to place a bet. Like we want to hear some thoughtful, rational thinking from these companies, from these VCs. And what goes along with that is that they have some industry expertise. The other thing, and any startup should be looking at, is kind of halo effects. If it's a big name VC, we want to partner with them because it creates a situation where the company can raise a higher valuation in the next round because they're on their reputation. One of the other things we're looking at here is not just the track record of the VC itself, but also of the partner that's leading the deal. And one of the things we also look for is when they do an inside round, do they go super pro rata? Like, is this a company, I mean, is this a VC that really backs its winners and they have deep pockets and they're reliable? Those are the kinds of things we look at. So, if you look at the kinds of VCs we're co-investing with in life science and in tech, we've done 3 co-investments with Sequoia, Polaris, Sofinova, F Prime. Like, these are all very well-known, well-established firms. 4 to 6 co-investments with Canaan and Sutter Hill, GV and Deerfield, 5AM, and 6 co-investments with NEA, 6 or more actually, with Orbimed and NEA and Atlas. And Arch. And part of this is because they have, these are firms that we know have these characteristics that we're looking for syndicates, and we hope that your startups will also be looking for similar kinds of VCs to back them. Well,
I imagine with deep science startups, often that's going to be really important, is to have these types of syndicates then too.
Yeah, of course. Like, what you don't want to see is, you don't want to see a VC that's 90% of their portfolio is consumer-facing products, and then they're making this bet in deep science because they don't have credibility in the space. Even if they're a really well-established fund and they have a great record, the question is, why are they investing in this company? They don't know anything about this. And so these are also VCs that are steeped in deep tech, and they have that kind of expertise.
Right. All right, well, thank you so much, David. If we have any other more questions on the tech side that come up, we'll let you know. But moving on then to our life science financing trends. Anurag, I think you're going to be taking us through these first few slides.
Yeah, thank you, Kirsten. And as David mentioned on the tech side, the life science has also seen a stellar year in 2018 in terms of VC investments. And if you look at the table below the graph, the total investment in life science deals has gone from $16 billion to 25, which is almost about 50% increase in the total investment. And this has been primarily driven by biopharma, where the investments have increased from 8.4 to about 16.2 billion, almost doubling in the total investments. And this is a trend that we are seeing continue in 2019 and is most likely to continue for at least a couple of years looking forward. And Stephanie will talk about the trends in device and diagnostics and a few challenges which may have limited the VC investments in that space. Next slide. Yeah, so if you look at therapeutics specifically, which has been the primary focus of VC investments, and look at our OUP partner institution startups, and look at what the total VC investments have been in that. The graph on the top in the bar shows the total dollars deployed in the therapeutic startup, and the blue line shows the number of startups that have been created. And what you'll notice is that there has been almost 3 parts of this bar graph. From 2010 to 2014, where around $2 billion every year were deployed. While there was a shift change from 2014, where the investments have really increased to about 3.5 billion. And 2018 has seen another step change, where it's gone to almost 5 billion. And the way the Q1 of 2019 has gone, it's projected that it will stay on par with 2018. And this really shows that, the VCs are really moving towards and focusing on the VC, on the therapeutic side. But what makes it more interesting is if you look at the total number of financing, and over the time when we have seen this dramatic increase in total investments, the number of financings have remained relatively constant from 208 in 2014 to about 185 in 2018. And this really, reflects what we've been seeing in the market, that, though the amount of dollars have gone in has increased, the dollars per company has dramatically, increased compared to the number of new startups. So, there were 16 financings in 2018 that were above 75 million, compared to an average of only 6 financings per year since 2015. So we are seeing these mega rounds where almost Series A and Series B are being combined. And that's what is driving this dramatic increase in total investments. And even the number of financings that you see in the Q1 of 2019 is actually significantly down. It's 36 compared to 50, for the Q1 in the last 4 years. And this again shows that the trend for the VCs, like in the tech sector, is to find a few companies that they like and deploy large dollars in that, rather than trying to fund more companies with smaller dollars. Next slide. So if you look at, therapeutics overall is an attractive area, but where exactly in therapeutics are these, financings being done? And this may not be a big surprise to most of you who are in the life science field, that oncology really leads the charge in VC investments. It was in 2017 and has stayed that way in 2018. So if you look on the left-hand side, the total number of deals again has gone up slightly from 102 to 117 for oncology, but the total amount of dollars deployed had increased from 2.8 to almost $5 billion. And so following oncology, there is, the other key areas that, VCs have been focusing highly on are platform, neurology, orphan, and rare diseases. And of these three, I would highlight neurology specifically, because if you look, the total number of financing from 2017 to 18 has also seen a significant uptick, along with the total number of dollars deployed, which has almost tripled from about $500 million to $1.5 billion in 2018. So again, this trend seems to be continuing, where VCs focus on oncology and platform deals, with neurology being the new upcoming star in this area. And if just on the right-hand side, that trend is kind of what we see in the Series A, as we see in the total investment. It kind of mirrors everything, that the Series A sizes are getting bigger. Most of the financings are Series A, and the VCs are continuing to focus early and early. Next slide.
Actually, Anurag, a couple of questions for you. For the platform category, how can you talk about a definition of a platform?
Yeah, and this is a little bit difficult to tease out, because some of these platforms, when they start, they don't have a specific focus or any specific therapeutic area focus, and they discover as the platform is built. So for an example I would give is like companies like Arrakis, which is one of our portfolio companies, is targeting mRNA with small molecules. Now, they have multiple indications on the tables, which is going from oncology, neurology, to rare diseases. And as the platform matures, they'll decide what indication is most attractive and most tractable. So these, such kind of technologies, which can be applied to multiple indications, would be captured in platform. But I think the exact breakdown is not available, as this has been available from SVB report, where the definitions are maybe a little different.
But I think that's actually very helpful. And the other question that came in was on the previous slide. There was that peak of 208, I think it was the companies. Do you know why that particularly was a peak in 2014? I mean, it's not that much different, I think, than the other numbers, but was there a certain reason why that was a peak?
Nothing specifically that we noted. And again, these numbers are not exactly precise. They have error bars around them. And so is it significantly higher? I'm not sure that is the case. Nothing that pops up in my mind that would lead to it. The only thing could be is that's when the public market started opening up a little bit. And as people got exits, they may have deployed dollars into new startups. Or a new financing. That may be it, but that's more of a guess on my end than any data behind it.
Yeah. Okay. Thank you. All right. So if you look at, we've looked at what the areas or therapeutic areas where we make investments, and if you look at geographically within the U.S., where are these dollars being deployed? And again, most of it may seem very reasonable and like previous years, where California, Northern California, Southern California, and Boston, Massachusetts area, they're really leading the charge. And they're the top 3 regions where the dollars are being deployed. New York has recently emerged as a big biotech hub and has, for the last couple of years, has taken that 4th place. But what is really surprising is, Pennsylvania, our backyard has really popped up into the top 5 regions for the first time. And this has really been driven
by successes of a few of the cell therapies that have been approved, gene therapies that have been approved, where you can trace those origins to Penn and other institutions in Philadelphia area. And that has really sparked a lot of cell and gene therapy startups being spun out in the Philadelphia area and actually being based in the Philadelphia area. Even now, Iovance, one of the cell therapy companies, just announced that they're going to have a new manufacturing facility based in Philadelphia, which is being trying to be rebranded as Silicon Valley. And that has really changed. If you look, the number of deals are still pretty tiny, only 9 Series A, but the amount of dollars raised is significantly large, almost about $500 million, which is on par with San Francisco and Boston area in terms of average size of each deal. And again, this shows that cell and gene therapy companies require large dollars. And with some regulatory successes from Penn and CHOP, I mean, we are seeing an uprise in the number of startups that are being formed. Next slide. So, after looking at why has this been, a rising trend in the VC investment, and one point that I mentioned earlier was, opening up of the IPO market. And that is something that all of us have seen, that companies are going public much earlier, raising large amount of dollars on the public market. And that is really, seen in this graph. If you look on the left-hand side, as 2014 was the highest number of IPOs that were done. And slowly that has been on the decline. But 2018 has really jumped up to 54 IPOs in that year compared to 31 and 28 for the previous 2 years. While the IPO market has opened up, the number of M&A deals have relatively remained constant, anywhere between 15 to 20. And this may just signify that, given the appetite of the public market to take earlier companies, maybe, the VCs have got another way to take the companies forward. The companies have one more option of financing on their hands, and there may be better valuations that are available on that market. So if you look at the bottom of the slide, that actually really highlights how the IPO market has, provided companies with better valuations. So if you look at the year 2014, when 66 IPOs happened, which was quite similar to 2018, where 54 IPOs took place. But if you look at the blue bar in the bottom graph, the pre-money for IPO was $135 million in 2014, while it is $325 million in 2018. Now, that's a significant increase in the pre-money valuation for these companies, given the observation that we are seeing these companies go public even earlier than what we used to see before. On the other hand, the M&A upfront has actually declined over time from, being upfront from $213 million in 2013 to only about $153 million in 2018. And this can be, for a number of reasons. One, most of the attractive companies, because of valuations, are choosing to go public than be acquired. On the other hand, the acquirers are thinking that this market is rich and the companies are overvalued, and they're waiting for, a shift change to happen in the market before they, really ramp up on their M&A activity. And we did see this something at the end of the 2018, when the public markets kind of melted a little bit. There was much more M&A activity by pharmaceutical companies than earlier in the year.
And so, Anurag, the M&A upfront, so that's the upfront payment that the startup company was receiving when they were acquired or merged.
Exactly.
Right. Okay, thanks.
Yes. Next slide. So, again, looking forward, we've talked about trends that have been in 2018. And if you look at what has been the attractive areas and what's been reduced excitement, again, I'll say upfront that, these are just guesses, because if you really knew the reality, we would be much better investors for a fact. So, but what we have seen in the market and what we expect to go in 2019 is a few things like cell therapy, gene therapy. They're going to continue to be very attractive. There's going to be a little bit of shift on what kind of cell therapies are becoming attractive. Going from just the liquid tumors, opening up the solid tumor space, looking for some better safety profiles, and actually expanding the use of cell therapy outside oncology is slowly becoming attractive. And one example is Sana, one of our portfolio companies that is, everything related to cell therapy. On the gene therapy side, most of the gene therapies have been focused on the liver or on the eye. And so just expanding the tissue focus for these gene therapies is going to be, become more attractive. Novel capsids, novel expression cassettes, assets that are closer to IND, which actually academic institutions are very good at doing in the gene therapy space, are going to be quite attractive. Outside cell and gene therapy, autoimmunity is becoming very attractive, and novel targets or difficult to treat targets, which are well validated in the diseases, are going to be also hot areas for VC investments. And as previously mentioned, there has been significant uptick in neurology, and we expect that to continue. And specifically, looking at more orphan neurology diseases which are genetically defined and where the biological risk, as to say, can be reduced by looking at specific mutation populations. Now, these are attractive areas. A couple of areas where VCs have kind of shifted their focus away from, and those are fibrosis and immuno-oncology. Fibrosis specifically, there has been a lot of, assets that, are getting really close to phase 3 results, and therefore the treatment landscape is expected to change significantly in coming years. And therefore, that has halted VC interest in very early stage fibrosis assets. Additionally, there has been some uncertainty around the reimbursement in fibrosis, and most VCs would like to play that out before making very early stage investments. Similarly, in immuno-oncology, as we all know, there are 1,000 trials going on in combinations with PD-1, and we have seen some major failures in this field, and this has led VCs to kind of take their legs off the gas and just wait to see how the market plays out and what the treatment landscape looks like before making early stage bets again. So again, in these fibrosis and immuno-oncology area, we'll see some investments, but there'll be much more caution than what we have seen in the past years. Next slide. The last topic that I cover before we go to devices and diagnostics is, what may be the most relevant to our audience is which are the VCs that are actually doing company formations and what kind of money have they raised? Because that's truly what drives the innovation out of academia and get it into a company and commercialization path. And so what you see is like over the past 4 years, we have seen significant amount of capital being deployed by all these major company formation VCs. And on an average, about $2.2 billion are being raised every year by these VCs. So there is a lot of capital in the market. And the key focus for all of us should be is how to market our technology, how to align our interest with the VCs and get them to look at the right startups, because if they find the right technology, I think they have the capital to deploy. And if you see, all of the VCs are raising every 2 to 3 years are raising a new fund. And so being on top of that and keeping track of who is on what fund cycle could be critical in understanding which VCs are the right fit for which technologies. So I think with that, I'll end the therapeutics section. And if there are any questions, we'll take those.
So there aren't any more questions at this point. We'll see if others come in for you, Anurag, but we'll pass over to Stephanie now.
Great, thanks, Kirsten. It's always challenging to have to follow up the therapeutics sector slides because the activity there has just been so robust in terms of the number of deals and the capital invested, and even the exit environment is really strong. But I will say, for devices and diagnostics, there are a few bright spots. I think both sectors lag the activity seen in therapeutics overall, but it is in some ways a little bit better this year than it has been in previous years. Whether or not those are trends that continue going forward is hard to predict. But I think one of the biggest bright spots for medical devices was just the amount of capital that was invested in the space in 2018. So it was up by 40% over 2017, which is pretty fantastic, with just over $4 billion invested in the sector overall. And what is particularly exciting about that is that a lot of that was going into Series A investments. So there was a 30% increase in Series A investment activity. And this is significant because in previous years we have seen time and time again, and even in our conversation with other life science investors in the space, what we hear is that, oh, well, we're still active in the device space, but we're only doing late stage investments. So to start to see an increase in Series A investments, I think is pretty promising. And we'll see if that continues going forward, but for now, it's potentially, I think, a good sign. In terms of the sectors and the device space that are capturing the most investments, it's not surprising cardiovascular is far and away the largest. I think for at least the past 3 years, this has been the case. And that's followed by the neuro and surgical sectors. And so no big surprises there. Those tend to be usually in the top 3 or top 4 sectors that are capturing the most investment dollars. But another important positive note for the device sector has been with exits. So obviously, as investors, when we're considering putting capital into a company, we have to see a path towards a meaningful return in a time frame that makes sense for our fund. And that in previous years, it has been challenging for devices. But there was in 2018 a really big uptick in the exit activity. And this was both for M&A and also for IPOs. Boston Scientific was the most active, so they acquired 7 VC-backed companies. But also the IPO window opened up a little bit, certainly not as wide as it is for Therapeutics, but it opened up a little bit really for the first time since 2015. So there were 8 IPOs in the device sector last year, which is exciting to see for investors, and it's hopefully something that will continue going forward. Next slide. I'm not going to go through all of the investors on this list, but one of the questions that we get time and time again from TTOs is, who is actually investing in medical devices? And if you have a technology and you're trying to figure out who to send it to, who are the right folks. And so this slide just shows the most active investors for devices in 2018. The graph on the left breaks it down by the number of deals that they've done. So a lot of these funds are doing several device deals per year. Some of the names are ones that you have probably heard before: NEA and Lightstone. Boston Scientific also has a venture arm. And some are relative newcomers to the space or some larger angel family office type networks. And then on the left-hand side, we've just listed who the most active investors have been, broken down by stage of investment. So Series A at the top, the more earlier stage, and then Series B at the bottom, the investors who are still a little more focused on late stage investments. And for both of these groups, these active investors, they have made at least 3 investments in the medical device space. So I think it's safe to say that for device technologies that are looking for investment, these are probably good firms to start with in terms of outreach. Next one. So one of the things, I mentioned earlier that it's important as an investor to always be thinking about what your exit is. And this slide, it breaks down the exit values and the time to exit by device category or the regulatory path. But I think the overall takeaway is that we're starting to see that at least for upfront multiples, the device exits are actually, they're getting close to what is seen for therapeutics. So if you look at that middle column, the median upfront multiple, so for therapeutics, it was 4.5x. And for the, whether it's a PMA or a de novo 510K, those multiples are actually, the de novo 510K, in fact, is a little bit higher than therapeutics. So at face value, it starts to look pretty attractive. But where devices are still really lagging is the median time to exit. And I think that's something that still troubles a lot of investors and is probably keeping them from jumping back into the device space. So the median time to exit for a therapeutics company was 4.2 years. But if you compare that to what you're seeing on the device side, I mean, it's a significant difference. I mean, the lowest being for a PMA pathway, and that's 6.1 years. And so, I mean, it's at a minimum 50% higher than what you're seeing in the therapeutic space. And just as an investor, it's really challenging to look at those numbers and to get excited about the device space. Next slide. So finally, turning to the last sector, so this is diagnostics and tools. Here, the investment amount remained pretty much flat. There was an increase in the number of investments, but really no change in the total capital invested. What was somewhat surprising, so the number of Series A investments were down in 2018. And one possible explanation is that some of the investors who have in previous years come in at the early stage are just waiting to see how their investments play out over time before they make additional early stage bets in the diagnostic space. And so because of that, the bulk of the capital going into diagnostics and tools was going in later rounds. So that's Series B or even later. And then within diagnostics and tools, it was really the R&D tools subsector that got the most investor interest and capital. And then touching on exits again, this is a bright spot. I mean, this is certainly an improvement over 2017. I don't think it could really be worse than it was in 2017. But 2018 is starting to look pretty good. Not as strong, obviously, as therapeutics, but strong relative to the previous activity seen for diagnostics. So it was great on the M&A side. There were 10 transactions in 2018. And the IPO market still, it remains a challenging path, if it is even really a path forward for diagnostics companies. So there were only 2 IPOs in 2018. So still from an exit standpoint, a pretty challenging space. And we don't have a separate slide on this, so I'll just talk through it. But the other challenge for investors is that the exit value is just not nearly as robust as what is seen, certainly for therapeutics, but also for medical devices. So the median upfront for exits in the diagnostic space have been just over 100 million, and the median number of years to exit is 9, which is a particularly scary number as an investor when you think that most venture funds are 10-year funds. You can usually extend them for 1 to 2 years, but with a median of 9, it makes it very hard to see a path to venture-like returns within an acceptable time frame for a typical venture capital fund. Next slide. And I think this is the last slide, but same as with medical devices, we just wanted to highlight those investors that are active in the space, because there are some that are quite active. You can see Keiretsu Forum, Alexandria, 10 deals. They're quite active. We've also highlighted, again, on the right-hand side, the investors that are most active at different stages. So the earlier stage investors are, again, at the top, those that have invested in at least 3 Series A rounds, and then the slightly more later stage investors, those that are focused a little bit more on Series B investments. And with that, I don't see any questions coming through. So
I actually have just one question. So yesterday, I think it was announced about this big financing in what I believe was a diagnostics company associated with Johns Hopkins.
Yeah.
Oh, sorry, go ahead.
Oh,
Thrive. I think.
right, yeah.
So
Another.
that was a terrific.
That was what, 110
million or something. Yeah. But anyways, that would seem like a positive note then for the space.
Yeah, I think it is. One of the brighter spots within diagnostics has been the liquid biopsy sector.
Okay.
There's been a lot of exciting development there.
Yeah. Good. I'm really glad to hear it. That's good to hear some bright spots, definitely in these areas. So thank you, Stephanie, Anurag, and David, for your thoughts today in all of these areas. I know this is a value to our community. We are reaching the end of our webinar. Before we sign off, and before all of you sign off, we would really love to collect your feedback on our webinar. You'll notice a link to our survey coming up in your chat box. If you could fill this out, we would really appreciate it. It will take you less than a minute, so please just go in there right now and fill it out. We listen to you and your suggestions on topics for our webinars. For example, in 2 weeks, actually I think on June 11th, we have a webinar that is going to be on talent searching for startup companies, and that was based off of suggestions that we've been hearing from all of you. So if you could please fill it out, we'd greatly appreciate it. And then before we close out, does anyone on the investment team have any closing remarks you'd like to make, or a takeaway that you'd like the audience to have from what you talked about today?
Yeah, I mean, I'll start. I'll say, one thing to keep in mind is, when I was talking about the graph earlier about the intersection of what is funded research and what is research that gets invested in, it's not a complete overlap. And so it's really important to remember that just because something is getting lots of research dollars, it may not be fit for a commercial effort. And if there is, if you think there is a commercial opportunity there, I would encourage you to press the inventors and the early startup group for use cases, to really focus on business commercial use cases, and to preferably talking to potential customers, partners, channel partners, understanding the landscape and using that to inform like what are the best use cases, because that really is what investors are looking for when they're investing in things that are usually funded by research dollars.
Great, thanks, David.
Sure, yeah, I'll go next. I would say for the device and diagnostic sectors, while they have not been as robust in terms of investment activities, when you're thinking about what investors to introduce technologies to, I would say these slides I think are available after the webinar. Go back to those slides that listed the most active investors to make sure that you're tailoring your approach to folks that you know are active in this space.
Great. Anurag, sorry, go ahead.
Yeah, maybe just one thought that, though the VCs are really focusing on therapeutics, their interest changes quite rapidly. What was attractive to them in the IO space a couple of years back may not be as attractive anymore. Something that was not attractive a few years back, maybe like neurology, is starting to come up. So I think it's going to be very prudent for everyone to keep in mind on what the trends are in the industry and match up with these VCs accordingly. All of them have reloaded their funds. They have fresh capital to deploy, but that's deployed in very few startups. And, to make sure that your startup is one of them, you would have to make sure that there is good alignment with VC interest versus what technologies are being pitched. and that changes quite, rapidly.
Great. Thanks so much, everyone, for your thoughts. We did have a couple of last questions before we end. So one is about getting the slides. We will provide those actually to everyone who registered for the webinar. We've also recorded this, and so it will actually go up on our YouTube channel in a while as well. And the last question was basically talking to the audience about the difference between pre-IPO money and non-pre. Sorry, the question went away. So,
Kirsten, I just answered it on text. I didn't realize.
Okay, thank you
yeah.
so much. So it basically was pre-money is the valuation before the funding is raised. And we can follow up on this question too if other people have questions on pre-money, what that means. So thank you all so much. If you do have any additional questions for our listeners, if you have any additional questions, you can see the email addresses for everyone who's been on this webinar today up on the screen. Please feel free to always send us questions. And thank you, everyone, for listening to our webinar today, and enjoy the rest of your day.